Hey, it's Mark Ferguson with Invest for More, and this is a property I bought a few years ago with a 1031 exchange. It was a crazy property, had all kinds of crazy issues going on with it, but it was really cheap, ended up being a great investment. And what we're going to talk about today is the White House's plan to try and get rid of 1031 exchanges or greatly limit them, and what that could mean for real estate, what that might look like, and if there's any chance of it actually happening. So there's been a lot of information out there, a lot of contradictory ideas too about real estate and getting more houses built and investors and different things that we'll talk about in this video. Now there's so many different things we could talk about in the White House budget and tax proposals and tax increases and different things. It would take hours. So we're just going to talk about 1031 exchanges in this and maybe a tiny bit of other stuff, and maybe we'll cover some other issues as well. And if you want to comment and let me know on if you want some other issues covered and what those would be, love to hear it. If not, let's get right into it. So a 1031 exchange allows an investor to sell one property and pretty much dump all the proceeds from the sale of that property into a different property and not pay capital gains tax on the sale. So there's a lot of restrictions, a lot of different things you have to do to make it work. But basically, on this one, I sold a single family home for around $300,000 in that price range. And I had $100 and some thousand of cash proceeds from that sale. So I was able to take those cash proceeds and put them into this property, which I bought for $410,000, and not pay taxes on the gain, because I think I had bought that single family home for like $89,000 or something crazy. So I had a big gain. I was able to not pay taxes on that gain because all the money I made from that property went to this property. Now I wasn't allowed to take any cash out of it. I wasn't allowed to take, some of the gain, and or I would have had to pay taxes on it. I also had to buy a property that was more expensive than the property I sold. I had to identify it within 45 days. I had to close the new deal within 180 days. There's all kinds of rules and restrictions. And I've ended up doing 3 1031 exchanges, but I've also not done 1031 exchanges on some rentals I sold as well, just because of the restrictions and because of the limitations. And I didn't have properties I was ready to purchase. So there are pros and cons to it, but it definitely is a huge advantage for investors, because when you sell a rental property, like I said, there's taxes that you might have to pay on the gain. Well, you also depreciate a property when you own it, and you've got to pay recaptured depreciation as well when you sell a property, and those taxes can add up fairly quickly too. So this is an interesting property. It had 3 houses on it plus a commercial property. We ended up doing cash for keys on a couple of the properties. They weren't really paying rent, although they said they were paying rent. We fixed them up. Another property we had to do an eviction on. That was one of our crazier evictions, where not for the inside of the property, but on the outside, they just had stuff everywhere and would not move it. And then on the commercial shop, we had a mechanic who rented it for a long time until the city pretty much told him he had to leave because it wasn't an approved use in this area. They wanted us to do a variance, which included getting a survey, engineer report, basically maybe even change the property lines. Basically, they want us to spend $20,000 to let that tenant stay who was paying like $1,600 a month. So now we use that as my personal shop to store stuff in. So what might change with the new rules? All right, so we're looking at a fact sheet from the White House, direct from them, because I want to use their perspective first. And this is on the budget, which includes all kinds of different tax proposals and different things. Basically, they said they want to make big corporations and the wealthy pay their fair share. We'll talk a little bit about that too, but I don't want to spend too much time. We want to get down here to the real estate side of things. Here we go. Eliminates tax subsidies for real estate. The budget closes the like-kind exchange loophole, a special tax subsidy for real estate. This loophole lets real estate investors, but not investors in any other asset, put off paying tax on profits from deals indefinitely, as long as they keep investing in real estate. This amounts to an indefinite, interest-free loan from the government. Real estate is the only asset that gets this sweetheart deal. Now, first off, if it's the only asset that gets this sweetheart deal, one might say, well, we've got to eliminate it. We can't have anybody getting a special deal. Or the other perspective is, hey, why don't we give this sweetheart deal to other businesses and help them and encourage businesses? But of course, that would never gain any ground, because we know it's all about increasing revenue and taxes and not decreasing them. That's, again, another story. We won't get too far into that. So we're going to talk about the specifics of what this means, because this is very vague, obviously. But then we also want to talk real closely about this, the wealthy paying their fair share, because I feel like this is very misleading. Especially this requires billionaires to pay at least 25% of income taxes. Billionaires make their money in ways that are often taxed at lower rates than ordinary wage income, or sometimes not taxed at all, thanks to giant loopholes and tax preferences that disproportionately benefit the wealthiest taxpayers. As a result, many of these wealthy Americans are able to pay an average income tax rate of just 8% on their full incomes, a lower rate than many firefighters or teachers. To finally address this glaring inequity, the president's budget includes a 25% minimum tax on the wealthiest 0.01%, those with wealth of more than 100 million. Now, what really bothers me the most is this is completely misleading, and people are using this statistic all the time, where they're saying wealthy Americans are able to pay an average income tax rate of just 8%. That is 100% false. That is not an income tax rate, and we'll show you what it really is here. It is a wealth tax rate, and we'll talk about the difference. And also, the budget includes a 25% minimum tax. That is also a wealth tax, meaning it's not based on money you make. So if you make $100,000 a year, you should pay income tax on the money you earn, that $100,000. That's an income tax. Well, a wealth tax is if your house goes up in value $100,000 in 1 year, your wealth increased to $100,000. They're saying you should be paying taxes on that wealth increase, even though you don't actually see that money. It's not in your pocket. You're not selling the property. It's just that because your wealth went up, because your asset values went up, that you should be paying tax on it. So I am vehemently against that. I will make no bones against that. I believe the government already collects record amounts of revenue for taxes, and we've seen some of the way they spend that money. I would say that they don't need to come up with new ways to tax people. They should probably be coming up with ways to spend less money, but that's my opinion. Unfortunately, the government kind of gets a free ride where they can spend whatever they want without having to make a profit, without having to show it accomplishes anything, and then they can just keep taking more money because it's not theirs. There's my rant. Okay, let's show you what this really means. Okay, I finally found it. It takes some time to find these because they kind of hide it a little bit. And this is actually from September 2021. But here's how they actually figure that 8%. We estimate the average federal individual income tax rate paid by America's 400 wealthiest families using a relatively comprehensive measure of their income, not true, that includes income from unsold stock. We do so using publicly available statistics from the IRS Statistics of Income Division, the Survey of Consumer Finances, and Forbes magazine. In our primary analysis, we estimate an average federal individual income tax rate of 8.2% for the period 2010 to 2018. We also present sensitivity analysis that yields estimates in the 6 to 12 range. The president's proposals mitigate two key contributors to the low estimate rate: preferential tax rates on capital gains and dividend income, and wealthy families' ability to avoid paying income tax on capital gains through a provision known as a stepped-up basis. So the wealthy pay low income tax rates year after year for two primary reasons. First, much of their income is taxed at preferred rates. In particular, income from dividends and stock sales is taxed at a maximum of 20%, 23.8%, including the net investment income tax, which is much lower than the maximum 37% ordinary rate that applies to other income. Now, first, what's interesting there is that you make money, you pay taxes on that money, then you take that money and you might invest it in stocks, and then that money might make money that earns income, and then you're taxed on that money again. And yeah, that rate's a little lower because it's not actual earned income, it's investment income, because they want to encourage people to invest in things and build things and have companies do well. And that's the whole reason behind that. All right. Second, the wealthy can choose when their capital gains income appears on their income tax returns and even prevent it from ever appearing. If a wealthy investor never sells stock that has increased in value, those investment gains are wiped out for income tax purposes when those assets are passed on to their heirs under provision known as a stepped-up basis. So basically what this is saying is that the current tax rates for the wealthy are wrong, because if their stocks go up, their assets go up in value, just like your house might go up or your stocks might go up. You aren't paying taxes on that increased value. And so this 8.2% is based on their assets going up in value, not the actual money they're making, or if they sell stock, or if they make money from their company. That is taxed. They pay taxes on that. But the White House is saying they should be paying taxes on all of their wealth, whether it increases or not. I'm assuming they're not going to give any refunds if your wealth goes down, but that's how they get that 8.2%. We'll show you what the actual effective rate is, which is what people pay after deductions, all of that, because that's really what's important in my book. Okay, we're at the Pew Research Center, and this is the federal income tax effective rate. So that's basically what people end up paying, not what they say the brackets are or what taxes are. This is what people actually end up paying. So you can see the people who make more than 5 million pay 26% of their income in taxes. People who make 500,000 to 5 million pay 25%. People who make 200,000 to 500,000 pay 16%. People who make 100,000 to 200,000 pay about 11%. Those who make 50,000 to 100,000 pay 7%. Those who make 30,000 to 50,000 pay 4%. People who make 15 to 30,000 pay about 2%, and those who make under 15,000 pay 0.21% taxes. And basically, if you look at the stats, the top 1% of the country pay about 43% of all taxes. Now they make the most money, they pay the most taxes, but this idea that the rich are paying less than firefighters or teachers is just not true unless you say it's based on wealth. And I don't think that's accurate. I think we should be basing it on income earned, not wealth. So this is what shows you what the true taxes are. So I know we got off subject. I want to clear that up a little bit. Now let's talk about what the 1031 exchange might do. Okay, so we're at the taxfoundation.org, and they give us more details on what the proposal actually says, because those White House fact sheets don't really give us the details, and it takes a lot of time to sort through them and find them. But here are the major individual capital gains and estate tax provisions modeled. So one interesting thing is increasing the top income tax rate. Here's another one that could greatly affect real estate investors. Tax long-term capital gains and qualified dividends at ordinary income tax rates for taxable income above 1 million, and tax unrealized capital gains at death above a 5 million exemption. So a lot of people might say, well, it's just for rich people who make more than $1 million a year, their capital gains will go up. Well, if you were to sell a large property, for example, I've got a couple of properties that are worth more than $1 million. I have one that is worth probably $6 to $7 million. And if I were to sell that property, it would probably have more than $1 million gain. Plus you would put that gain on top of my other income and different things. I would definitely be making more than $1 million in that year. That means instead of paying, the 20% capital gains on that property, which could be, let's say just for the fun of it, I make $2 million in 1 year. And again, that's after owning this property for many years, and you kind of get one big windfall on this property. If I paid 20% capital gains, that would be $400,000 in taxes I owed. And of course, this is a simple math here. If they were to make that ordinary income, it would be more around 40% tax rate. You'd pay $800,000 in taxes on that gain. So almost half of your income would be going to the IRS for that property. Now, that's kind of important too, because they want to limit 1031 like-kind exchanges to $500,000 in gains. So they're not trying to get rid of it completely. They're just saying if you have more than a $500,000 gain, you can no longer do a 1031 exchange. You have to pay taxes on that property. So for this property, this is my office building, my strip mall. If I were to sell it, I don't know if I could still do like a 1031 exchange into a property and just cap it at 500,000 and not pay tax on that 500,000, or they just wouldn't let you, who knows. But I could no longer do a 1031 exchange. I would also have to pay 40% income tax on it, not 20%. It would basically make me never want to sell this property. Just keep it forever until I die. And then hopefully, my kids get to keep some of that money because they want to change the unrealized capital gains at death as well, which would limit that factor too. And so a lot of people will say, hey, that's fine. Rich people should pay more in taxes. Well, this isn't just for rich people, right? If you own a business, let's say you've had a family business for 30, 40 years, it could be worth millions of dollars, even though it makes you a modest income right now per year. If you were to sell it, maybe it's worth a couple $1,000,000. Now you've had this business you've owned your whole life, your life's work. You want to sell it and cash out and retire. Now the IRS is taking 40% of that. And you can't do a 1031 exchange. And it's tough to do a 1031 exchange with businesses either. Always talk to an accountant for those things. So it could really impact a lot of people who aren't rich. Or, if you've got a family home you've owned for 40 years and it's worth more than $1 million now, and it's got all this equity, you're now paying taxes on that if you ever decide to sell it. It has a lot of implications besides just the rich or very rich, and it discourages investment too, because a lot of what I do in real estate, and actually is stuff like this, where I 1031 exchange into dilapidated properties with issues. We fix them up, we rent them to people, we provide nice housing for properties. A lot of times we buy rundown commercial properties, rundown apartments, we fix them up, we make them nicer, we provide housing and more options for businesses and people by investing that money. And one of the perks of that is you could do a 1031 exchange and keep moving that money into new projects and keep doing new projects, fixing up stuff. Maybe you sell it, cash out. Not really cash out because you can't keep the money, but put that money into a new project, fix it up, and just keep fixing up properties. It also has a lot of, if you can pay 20% of taxes on those instead of 40%, that also gives me a lot more incentive to do deals like this. Whereas if I know I'm losing 40% of my income, I don't know if I want to take on these risks and go through all the drama that so many of you know I have on my properties, and go through all the headaches of contractors and repairing properties and dealing with the cities and counties and all that. I just might skip it altogether and just leave these properties abandoned and vacant. And I know a lot of other investors feel exactly the same way. And what's ironic about this is that Biden and the White House have also put out statements saying, hey, we need more houses. We're short 4 million houses. We need more apartment buildings. We need more housing options. We need more investment into real estate. Yet, all of their policies they're suggesting would decrease investment into real estate. And so I don't think a lot of these ideas are thought through or really analyzed onto what they would actually do. A lot of them are just put out there to get attention, get in the news, like a lot of politics do. And that happens on both sides. I'm not just trying to hammer on one side or the other. It's just that one side happens to be in power right now, and they've proposed this, and I do not agree with it. Now, the good news is it most likely will not get passed. It most likely will not become law. They won't get this passed. So we don't have to worry about it right now. But it is something to worry about in the future. If one side gets more control and they are able to pass some of these things, get some of these policies passed, it could significantly decrease investment, significantly decrease housing stock, significantly decrease business, commercial, property stock. And by stock, I mean, inventory, not like the stock market, but the number of houses, number of properties. And that makes things more expensive. That makes housing more expensive, makes commercial properties more expensive. If commercial properties are more expensive, it makes products more expensive, like groceries, food, all of that. It all increases prices the more difficult you make it to do business. All right, so we'll see what happens in the future. I don't want to get too worried about this right now, but again, it is something to think about in the future. If we get more and more progressive towards higher taxes, wealth taxes, trying to decrease investment while at the same time saying we need to increase investment, you can't really have it both ways. You've got to go one way or the other. For right now, I'm not too worried about my personal self. I'll be fine no matter what happens. But it could definitely limit our investment into certain properties if things change significantly. And I know that will happen for other investors too. And one thing to consider is people who build apartments, maybe not people who build single family homes, but people who build apartments, people who build commercial businesses, people who, provide these needed, structures depend on 1031s and capital gains taxes and different things for it to be a good investment for them. And if those rates change significantly or they can't use them anymore, they might stop building. They might significantly slow down building, or they might just have to charge way more in rent, way more in sales to make up for it, to make it worth their while in the end. So we'll see how this works. Let me know what you think. Right now I'm showing our town tearing down buildings so they could have vacant land to sell, and this was years ago, and that land is still vacant and sitting there. So not to rip too much to the government on this video, but that's just another one that adds icing onto the top of that cake. All right, we'll have more videos on the laundromats, the liquor store, our flips, our rentals, our tenants, all of that coming up soon. Thanks for watching. We'll be back.